Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference, and I'm here with Stephen Hammer, who's a co-founder and chief investment officer of Compass. Steve, great to see you.
Thank you, I appreciate that.
You have a wide variety of smart beta-oriented ETFs, but run through the whole suite, there's one underlying theme. It's really, you've got a more broad diversification, is that right?
The biggest theme, with all these ETFs out there, there's a lot of ETFs with a lot of concentration risk, a lot of quantitative strategies, but the Kemp volatility weighted indexes are really a better, broader index when it comes to what is the market's doing, no matter where you're looking.
Yeah, so give me an example. Your typical ETF is going to have how many securities, and how does it you go from a universe this big down to the number that you end up with?
Well, if you look at the most popular cap weighting and you have a lot of concentration risk, you actually have most of your return coming from the top 50 names. It's really mega cap, not large cap. But when you look at all these ETFs out there, that some start with the S&P and that's very quant driven, very fundamental driven, narrowing it down to 20 names. Low volatility is really 3 sectors. So the question is, it doesn't really matter how many names. If you're going to rank or you're going to weight, how are you going to weight? Are you going to lean towards value? Are you growth oriented? So that is really important to look at in the ETF space.
Yeah.
And our objective is to represent broad 500 companies and equal representation on all companies.
Okay, so more equal weighting.
Well, equal weighted, most people don't know that the S&P equal weighted index has a beta of 1.2 in the last 10 years.
Yeah.
All your risk is in your aggressive stocks because they have the same weighting. What I mean is volatility weighting. So it doesn't matter if you're Amazon or Walmart, Netflix or Johnson & Johnson, everybody's on the same playing field. Believe it or not, the stock market does so much better actually every single year. Most people don't know that.
Okay, you mentioned something earlier about low volatility. It's been a pretty hot area, but you said that it's overweight 3 sectors. What are the 3 sectors?
Well, it's mostly energy, financial, and consumer staples.
Yeah.
You add that up, that's a very large percentage of that index. There's times where you love it, times where you don't love it.
Yeah.
It's going to be very deep value oriented. And so when energy doesn't do well or financials don't do well, it's just because it's low volatility. Now generally, yes, it would be, but there are times where it could get hurt.
When you work with financial advisors and you talk to them about your structure, how do they integrate your strategies into their overall ETF portfolio allocation?
If they're looking at our ETF, we help them understand this is a core ETF. This is the broader market. If you're going to look at some fundamental driven, some high dividends, that is for a specific purpose. Income, you want value, but if you're looking at our ETF and you're doing indexing, you really need to focus on, I want this as a core broad market index. I don't want to get hurt in any sector or value or growth depending on what type of ETF it might be.
Yeah, great. Listen, Stephen, I really appreciate the time and continued success.
Thank you, appreciate that. Thank you very much.